Okay, first of all, thank you for the invitation. So why this time might be different? I think maybe.
If you think it is different, you can disagree.
I think in substance, I fully agree with Bertrand. In
Okay.
substance, there is nothing new under the sun in particular. But I think politically it is. But maybe, well, I think it's been positively portrayed as, okay, now there is momentum, but there is also the flip side of the coin, that after what will be effectively the third attempt, there might not be a fourth attempt. So maybe this is the last chance to get it right. Okay, no, just political capital erodes, I mean, and credibility vanishes, and I think we take that there is the need, and maybe after two partial successes, not put it as failures, but partial successes, very partial ones, now is the time to get something more substantial. So I think it's it's always as in life, it's both push and pull factors that lead to success. So let's use both in the same objective. At different levels. Okay. So first of all, I think it's good in terms of final objective that a lot of political capital is put into this idea that what we are lacking mostly in terms of investment is in the equity space. Okay. So we have money. This is for the good of, I mean, we're fortunate that this is not a problem of lacking money. Quite the contrary. We have a lot of money. It's simply not in what we consider to be allocated in the most productive way. But what Verena mentioned is absolutely crucial. Allocation of investments at an individual level has to be mostly an individual decisions. And now I have the fear that some of the narrative that is going in, some of the initiatives are trying to, instead of pulling a string, we're pushing it. So we are basically putting taxpayers' money, and that obviously derives that has to be mostly a national initiative. So the traditional European method, I mean, it's insufficient in this regard, because you have to have a commitment of national tax authorities. But I fail to see, for example, this idea, but I mean, politically it seems obvious, okay? As long as you're incentivizing with taxpayers' money, then imposing these restrictions on asset allocation, 70%, but that's suboptimal. This should be much more organic, and in particular in the countries that this work more organically, even when they have a subsidy, you tend to be, you don't have these restrictions embedded in the label or in the product or whatever or the account or whatever you want to call it. I think we should try it maybe it may take longer and harder, but I think it would be more resilient if you do it the hard way. You improve the macro, you get more projects providing more attractive risk-return propositions in Europe, and then you'll have organically the people voluntarily deciding to invest more in equities. You may say, okay, that may take decades. Okay, fine, fair point. But I think it will be much more sustainable. Maybe this is just as a kickstart, might make sense. But if you believe the market is going to be driven by tax reliefs, with this restriction in asset allocation, if you believe that the traditional home bias is not enough and you want to impose even more on that, this is not going to be a vibrant and internationally competitive capital markets. But I fully share that if it's this to kickstart the market as a kickstart engine, okay, might do some part of the trick, but you have to think long term, and we need more equity in our companies, because that is what allows them to be more innovative. Innovation is funded mostly by the equity, not by debt. And for that, you have to do things also in the taxation space, but not on the demand side. It's also on the company side. We have debt equity bias. Our tax systems are biased in favor of debt. Why don't we focus on that? And that's, I think, it's more across the board. It's much more powerful, more long-term. I think, okay, maybe these short-term solutions can be a starting point, but we really have to think deeper on what is underlying. Not all central banks are cut alike. There are some nuances here and there. No, but I tend to be very financial stability oriented. I'm saying take that for granted. But I think in certain areas, so in general, the idea of deregulating at large, I think it's not very because of some evidence. It's anecdotal evidence, because you may also put it in the argument in the other way around. If in large stress you see no signs of financial stress, maybe you've overdone the thing. So I mean, that argument goes both ways. So I wouldn't take it in either direction. But I think in certain areas, at least, first, simplification is a must. I mean, is the argument of efficiency. Can you get the same outcome with less resources, less waste? I mean, that's a no-brainer. So that nobody should be against that. If you move one notch further in terms of deregulation, you can have the argument across the board, which I don't tend to share. But in specific areas, I think it's quite obvious we have to do it. And one of them has popped up before, which is securitization. We clearly know we overdone it, okay? Because the diagnostic was wrong from the beginning. There was, I mean, exactly the loss rates we had in that product in Europe were exactly as expected by the ratings. So, I mean, there was no problem in there, and we just bolted all the balls at the maximum, and we killed the market. We know we overdid it years ago. So now it's time to undo some of that work. And the problem is we don't know exactly which bolt we have to keep a bit looser, because there are so many. That's an area where I'd suggest to be as bold as you can, because you know that even if you go to the previous, if you undo everything, the system was as safe as it was supposed to be. I mean, it's simply we overreacted to problems in other jurisdictions. We're preemptive to a large extent. Of course, I'm not claiming we have to go to abolish everything, but we can be very bold and still be on the safe side. I want to be on the safe side. I'm financial stability oriented, but securitization was not, in that case, was not part of the problem. It performed in Europe as expected.
In the GFC, you mean?
Exactly as expected. No more, no less. And it was a big shock. It was a global shock. So here we are on the safe side. There are areas where you can experiment and areas where you cannot experiment. In this area, you are on the safe side. It's a control area, and you know you can experiment and be bold and still be on the safe side. So try to be bold in those areas. Areas which are in the unknown, please try to be conservative. But in this area, you can be very bold. And that's the beauty of, and I hope the Commission will get, because as I started, maybe there will not be a fourth time to get it fixed. So we have scarcity of time and scarcity of political capital to make this happen this time. The two things that I think are, or three things are more crucial, is going back to securitization. The idea of the platform that has a lot of potential, and as Bertrand mentioned, many countries have it. And in Europe, we've decided because we've been unable. And we've tried to skip the conversation. I think it's a shame that we have momentum, not really just say, okay, legislation is needed, let's not put political capital on this. That has transformative potential. The other one is centralization, some sort of centralization of supervision in certain key areas where it makes sense. Because even if it's not the best supervision in the world, you may think the system in one particular jurisdiction is better, but doesn't matter. One fair single supervision eases the life of the supervised much more than having to deal with excellent but different supervisions. So that has transformative potential. Let's concentrate on what has transformative potential and use it wisely. Sometimes, and I fully share, having too wide objectives at the same time and too many doesn't do the trick. So let's work together to make it happen this time.